Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money and your host for this session. Welcome to this episode in our series where we discuss the complex financial world's intricacies and bring insight that may enhance your financial understanding and contribute to your overall well-being. This episode is brought to you in association with ICICI Prudential Asset Management Company Limited. And today, our discussion will be around index funds versus exchange traded fund or ETFs. Mitigating risk through diversifying investments across asset class is a basic strategy. One of the strategies could be active or passive investments. Index funds and exchange traded funds are passive investments. Both have an objective of tracking underlying index and replicating its performance. Both are managed passively, avoiding the risk of actively managed funds, where fund managers' individual skills and judgment can impact fund performance. While both products track the performance of their underlying indices, they are not the same. To delve deeper into understanding their particular utilization in a portfolio, today we have with us Mr. Amit Vashisht, lead ETF, ICICI Prudential AMC. Let us commence the session now. Welcome, Mr. Vashisht, to this episode.
Thank you, Asha.
So, Mr. Vashisht, many a times people get confused between index funds and ETFs. So, to begin with, could you please explain for the benefit of our listeners, what is the primary difference between these two, index funds and ETFs?
Certainly. So before we'll start discussing, I think this is the hottest topic these days. People are looking into passive, but between passive, they are confused to go for index and ETFs. I think this podcast will help them to decide to go in which route. To start with, the primary difference between index funds and ETFs lies in how they are traded. Index funds are typical like normal mutual funds that are bought and sold directly through the fund company at the end of the trading day. It's like you're buying any mutual fund, you buy the index funds, you get an NAV of the day end closing price. Whereas ETFs,
Mhm.
so going forward for all exchange traded funds, we'll use an abbreviation called ETFs. For all ETFs, they are traded on stock exchanges throughout the day like individual stocks. So both typically track the performance of a specific index, but ETFs trades across the market hours, so you can buy the price across the market hours. That's a basic difference between these two.
All right. So this is the operational part that one can be traded throughout the day and one at the end of the day. So besides this difference, is there any other significant difference?
Yes, another significant difference is in how they are structured.
Mhm.
Index funds are typically structured as mutual funds, which means they are priced what we highlighted once a day at the end of the trading day based on the NAV, the net asset value of that particular portfolio. On the other hand, ETFs are structured as an open-ended investment companies, similar to mutual funds, but they trade intraday on stock exchanges at market prices. That may differ from the NAV of the underlying security. So I'll take another few seconds to explain.
Mhm.
We understand that the price trades on a regular basis in ETFs. NAV is what declared from the fund house sites. That's a real-time price of the NAV. But on the exchange, you purchase it on the trading price. So trading price can vary from NAV. It can be on the discount or on the premium of the NAV. So when you're buying an ETF, one thing is yes, definitely you're buying a real time. Within real time, the price you're buying might vary from the real time price. So that's give a major difference between ETF and index funds. You have to be a little active while buying an ETF funds.
All right. So how do these funds, index funds and ETFs, track market indices? And what is the frequency of churning the portfolio? So to match the index.
Sure. So both index funds and ETFs track market indexes by holding a portfolio of securities that closely mimic the composition of that index, which means whatever the index composition, ETFs and index funds both mimic the same portfolio. To give an example, the most popular product in India is Nifty 50. So Nifty 50, which is created by NSE, means top 50 companies of India in terms of market cap will be part of this universe. So ICICI have Nifty 50 ETF and Nifty 50 index funds. These two products will mimic the exact composition of the portfolio which is there in Nifty 50. So that's how the index fund ETFs work in the indices. As far as the second part of the question is concerned, how the churn of the portfolio. So the churn of the portfolio vary from the indices to indices. Some indices align semi-annually, some align quarterly. So with whatever the product mimic to, whatever the mandate of that indices, it will realign the portfolio. So what do you mean by realign of the portfolio? Like Nifty 50, you might see after 6 months one stock moving out of Nifty 50, another stock coming into Nifty 50. To realign with that, there is a realignment period, semi-annually and annually. So that particular period, we realign with the same portfolio. It can vary from quarterly, semi-annually, annually, depending on the product. Hope this will give little more clarity on this side.
Yes, so it depends on the fund and the ETF, and the frequency can be different depending on the in benchmark index you
Yeah.
choose. All right. So anyone would choose index funds or ETFs when want to invest in passively managed fund. My question is, should investors go for passive funds even if active funds are giving good returns?
Good question. So while passive funds like index funds and ETFs offer benefits such as low cost, broad diversification, liquidity, simplicity, and real-time price, there are instances where active funds may outperform the market or provide the unique opportunities. Investors should consider several factors before deciding between passive and active funds. Some investors may choose a combination of both passive and active funds to diversify their portfolio and capture different investment opportunities. It's essential to conduct thorough research and consider factors such as fees, performance history, and investment philosophy before making investment horizon. Although we have seen in last few years ETF and index funds have picked up in the Indian market thanks to the digital era and other things. With a lot of changes on the SEBI sides, now a lot of index funds have outperforming the active funds also. Smart beta come into the pictures, which have given a lot of investors to now choose within the passive sphere and active products. I hope this gives them a little clarity.
Okay. While they both aim to mirror the benchmark index, are these good to invest in the volatile market conditions, or especially when the market is in the downward trend? So, I mean, what is the right time to invest in passive funds, whether it is index, ETF, smart beta, or any other strategy?
So while index funds or ETFs aim to mirror the benchmark indexes, they are, so my understanding is index and ETFs are similar in terms if you want to time the market compared to any mutual fund. So
Mhm.
they're also like a broad diversified portfolio. So you don't have a risk of individual stock. It's like a
Mhm.
normal equity fund. You don't have any particular risk. So I just want to again clarify. Your question is basically index and ETF.
Yes, my question is that what is the right time to invest in the passive funds? Passive means index or ETFs. I mean, is it the what is the right time? And under volatility, is in passive investing better than in active investing?
Sure. So to start the question, what is the right time? So right time vary from investor to investor, depending upon their horizon, depending on their requirement. So if it's a long-term investor, they can look into an index and ETF or equity-based short-term horizon. We have products in the debt baskets. If you talk about the volatility market, so the basic difference between passive and active is that passive will not take a cash call. So what you mean by cash call? There is no fund manager. So when you're buying an ETF or an index fund, it's a passive product. You know what is the basket of that product. It will only mimic that product. Active fund sometimes can take a cash call, which can sometimes go in favor of the investor, sometimes it not go into the favor of the investor. So generally, if you are looking for the market on a short-term volatility, if fund manager take a good call and he taken a cash call, you might see a better risk-adjusted return in the active funds. But over a long period of time, you will see both products are doing pretty well because no one can time the market. So advantage with index and ETF is that it's a diversified portfolio, but you have to be clear that it's not actively managed product.
All right. So, if somebody wants to invest for long term, then passive could be a good strategy. But if I want to earn in short term and the market is going up, then active could be better.
Active equity is also a long-term strategy, but let's suppose a person want a more stable portfolio. You have a balance advantage kind of products in active, which are not available currently in the passive space. So the
Mhm.
investors who don't want to take that kind of volatility, they can choose those kind of products, which can increase equity level depending on the market levels. So that's why
Mhm.
if an investor who doesn't want to take too much of a risk and want to participate in the market, we recommend people to go into balanced category of products.
All right. Okay, so as there is no perfect timing and there is no perfect product which is suitable for all, out of these two, index and ETFs, what should one check to know the suitability? One is the cost, and what are the other factors?
Sure. So first, I'll take two common factors. First is the investment goal, which we highlighted. The investment objective should be clear that what are their investment goal, whether it's a long-term wealth accumulation, retirement savings. So once they know their investment goal, then they can decide what kind of product they want to buy within ETF and index fund. Second is the time horizon, where it's a long-term investment, it's a short-term investment. If it's a short-term investment, we recommend to invest into debt kind of ETFs or index funds. Long-term investment, they can look into an equity ETF and index funds. Now, some of the factors which differentiate between these two, you highlight cost consideration. So, if you compare the cost associated with index and ETFs, first of all, both index and ETFs are much, much cheaper than the active equity fund. But between two also, ETFs are much more cheaper compared to index funds. In some cases, it's one third of the index fund cost, one fourth of the index cost. So that's one other thing you can see between the ETF and index. Similar products, ETFs are much cheaper than the index funds. But you have to consider that there is a bid and ask spread risk while buying an ETF, which is not there in the index fund. Most important factor between ETF and index fund is the comfort with trading. Evaluate your comfort level with trading on the stock exchange. If you prefer the convenience of buying and selling shares throughout the trading day, ETFs may be more suitable for you. If you prefer a more traditional mutual fund structure with end of the day pricing is okay for you, index funds make more sense for those clients. Hope this clarifies the doubt between these two.
Yes, definitely, because you mentioned three things: investment goals, time horizon, and comfort of trading. So people who do not have demat, they may prefer investing through index funds, while both are tracking the same index and trying to imitate it. My
Correct.
next question is that are index funds, can we say that are index funds a slower version of ETFs from the investor's point of view?
In a sense, yes, index funds can be considered a slower version of ETFs from the investor's point of view, primarily due to the difference in trading mechanics and pricing, which we have discussed in detail that how ETFs work and how the trading mechanics. So yes, in terms of investor point of view, you can say that index considered to be a little slower version of ETF, but both will give a end result to the client is a better return.
Right. Okay. Are there other tax benefits also by investing in these funds, ETFs and index? And also, please shed some light on the dividend payouts. How does dividend work in these?
So basically, ETFs are also mutual fund. Index funds are also mutual funds. So their taxation is similar to mutual funds. So if you're buying an equity ETF or equity index funds, the taxation is similar to what you get in equity mutual funds or stocks. If you're buying a debt ETF or a debt index funds, the taxation is similar to the debt mutual fund. To explain to the retail investor in equity, if you're investing less than 1 year, it is considered to be a short-term capital gain. You have to pay a 15% tax plus surcharges. If you're investing more than 1 year, the taxation is 10% plus surcharges. In debt fund, now the taxation is changed. Whatever time horizon you keep your money, the return you generate will be added into your income. So that's on the taxation side. Dividend payout side also, the government have done a lot of changes this as a space. So any dividend which is declared in index funds or ETFs and mutual funds now will be in the hand of the investor as a income. That's why you see a lot of investors are moving towards the growth options. Even in ETFs, you have not seen in recent years any dividend payout as declared. So difference between index fund and ETFs, yes, there is an option of dividend index funds, but there is no such option in ETFs. It's on the discretionary on the fund house. A lot of fund houses are not declaring dividend because of the taxation reason.
As dividend is taxable, so people are preferring investing in the growth option instead of dividend nowadays.
Yes.
All right. In the Indian context, how have the performances of these two been over the past few years in comparison with each other, and especially during the market volatility last few years?
So in the Indian context, both index funds and ETFs have gained popularity among investors seeking passive investment options. So we have seen that it's a uptick. It's no more for the provident funds and the big investors coming into passive space. A lot of retail investors have started looking into passive space. While the performance of the specific index funds and ETFs can vary based on the factors such as underlying index they track, what are the expense ratios, what are the tracking errors, they are some of the parameters in which you can see some of the gap in some of the returns on some of the products. But the best part, what we have seen post COVID, is that in this digital era, retail investor now can easily buy these passive products. These passive products are 1/10 of the cost of the active products. So a lot of retail investors now get a chance to buy these products easily. Cost is one of the factor for them to buy it. That clarity they get while buying this product, understanding of this product is quite easy compared to any other equity fund. So these are some of the things: simplicity, understanding, digital, cost gives an edge to passive to the retail investors who come into this market. They understand this product very easily, and that's why they are starting adding this into their portfolio. Now, your other question, during market volatility and downturns. So the advantage of these products with stock is it's a more diversified portfolio. So you're able to stabilize your portfolio if you're buying in ETFs, index versus stocks, because the risk is not concentrated. That's an advantage you get. Same as in active mutual fund as well. Second thing, what we suggest always during market volatility is to do a regular investment, which is called an SIP. You can do an SIP in ETFs now or index fund, so that you can average out your price over a long point of time and you get a decent double-digit return. Considering that, also, we suggest clients to understand the risk involved in equity. And during volatility, you can see a lot of movement in the price in the ETF index fund, because it's a passive funds. Fund manager will never take a call. If you have taken an equity ETF, it will definitely going to hug those stocks. Those stocks go down, your portfolio go down. So that risk is always involved when you're buying a passive kind of a products.
All right, wonderfully explained. Now, my last question to you, whether one should choose index fund or an ETF, in equity or in debt, what should be the time horizon? One, and what are the conditions under which one should exit before the time horizon completes?
Sure. So basically, while index funds and ETFs can provide tax benefits, so tax we have already discussed in equity and debt. And in equity, we suggest generally whether you're coming in ETF or you're coming in index fund, clients should take at least minimum 5 years as a horizon, because equity is a volatile asset class. No one can time the market. Some investor can come at the top of the level of the market, some can come at bottom level of the market. So it's tough to time the equity market. So we generally suggest, if you're investing into equity, ETF, index funds, you should stay at least 5 years and complete the entire cycle, so that you can get a decent experience while investing into equity. If you're taking a debt as a horizon, it can vary from as low as 3 months investing into liquid fund, depending upon your requirement, to as high as to 5 and 10 year paper also. So debt product basket can move to as low as, we have a 1 day paper, to as high as 10 year paper. So depending upon your risk appetite and requirement, debt you can decide accordingly. Now, you last part of the question is when one should exit before the time horizon completes. So there are two things I want to divide into. The beauty about passive is that there is no human involvement. What I mean by human involvement, in active fund, sometimes you take a call, fund manager get changes, so you think that portfolio might get realigned. You don't know how that fund will now work. So that sometimes people take an exit call, depending on the changes happening in particular fund. In passive, there is no such risk. You know what this product is, how this product will behave, whether Amit is there or someone else is there. So that's a beauty. That risk is not involved. But definitely, if you feel that you have generated a decent return and you don't want to take more risk, you want to do profitability, you can do profitability in some of the in some of the equity ETFs. If you feel that you have achieved your goal before time, you can do profit booking and moving into debt ETFs. So that's called you can take, depending upon what kind of returns you have generated, what are your expectations. But we advise that you always stay till the time you have thought before investing into a particular asset class. Second most important is the taxation. If you are exiting on a particular asset class, whether it's equity, which close to 11 months, we suggest to cross at least 1 month more, so you get a tax advantage. Debt, there is no tax, so now you can take a call based upon your requirement. I hope that gives more clarity on this as a piece, and people now can understand what are ETFs and index funds.
Yes, definitely. For the taxation purpose, it's just 1 month left in completing 12 months. It's always good to keep invested and, reduce the taxation on the taxation part from 15 to 10%. And besides that, is just the goal, or I'm curious to know, because if the time horizon is 5 years if you are investing in equity, but around 4 years, you see that the market is going down and you feel that you should withdraw and put it in cash. So how should you think? Should you continue with that, or should you withdraw and put it in cash, or is there any other thing you can do?
So
Because time
what?
horizon is flexible, I suppose it is 5 years, but it could be more than that also.
Yes, definitely. The minimum is 5 years. So if you see the correction is happening, it's better if you have more cash, you should deploy more money at that point of time because you're buying at a discount price. Like we do shopping, when we see a 50% discount, we try to buy more product, more clothes while we're doing shopping. Same way while buying mobile, if it's we find a 50% discount, we definitely go and buy that particular product. Same in market, if you see a correction, that is the right time to add more units. Because then if you 10 rupees you're getting 1 unit, now it's come down to 5, you're getting 2 units in 10 rupees. So we suggest in volatile time when market comes down, you should add more investment to that particular time. Second question is, let's suppose your horizon is 5 year, market has done superbly well in 3.5 4 years and you have achieved your target. We recommend you can do a profit booking and moving into other asset class because it is linked to your goal. If you achieve your goal before time, you can do that profit booking and exit, it depending upon the time horizon.
All right. Thank you so much for explaining this all in detail. This discussion has been immensely insightful, and I'm sure that our listeners have gained clarity from this. Thank you, Mr. Vasist, for joining us today and sharing your insights with us. We appreciate your presence.
My pleasure. Thank you, Varsha. Thank you for inviting us.
So there are two different ways to invest your money depending on your interest and goals. One needs to have a demat account to invest through ETFs, but it is not needed for investing in index funds. While both aim to replicate the indices, investor may choose any of these based on their goals and convenience. It's important to note that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. With this, our today's episode of Investment Made Easy podcast comes to an end. For further exploration of investment topics, stay tuned to Outlook Money's podcast series and don't forget to like, share, and subscribe to stay financially informed. If you have suggestions, feedback, and questions, please do send us a mail at letters@outlookmoney.com and stay tuned for our next edition. Until then, stay informed and continue to follow Outlook Money, your go to personal finance magazine.